Hi, everyone. Thanks for tuning in to episode 23 of Takeaways. My name is Patrick Searcy. I'm Director of Marketing for ALN Apartment Data, and I'm joined by the star of the show, Senior Market Analyst and very well traveled, Jordan Brooks. Jordan, how are you?
I'm doing very well, Patrick. How are you?
I'm doing great. We're talking about the article from June, and it's called Class A Shows Resilience. Now, one thing that I'm curious about here that I didn't see was explicitly talked about in your article is the broader apartment demand and rent growth performance for the industry as a whole so far this year. So before we get into the price class info, can you give me a little bit of an update there?
Yeah, that really provides some good context for kind of the rest of what the newsletter was about. So, at the national level, we've seen net absorption about 70% lower through May of this year than through May of last year. So that's been probably the most dramatic shift from a sort of performance metric perspective that we've seen for multifamily so far this year is that softening of demand. And it's really not so much that it's down compared to last year, because last year, of course, was such a great year for multifamily demand. But if you even compare the January through May period of this year to 2019, which of course 2020 March, April, May was really already feeling the effects of the pandemic. So if you go back to 2019, apartment absorption this year is actually about 60% lower even than 19. So the shortfall is fairly dramatic, even aside from the comparisons to last year. And then on the rent side, we've seen about a 5% average effective rent gain for new leases this year, which even outpaces last year, which was about 3.6 at the same time of the calendar. So rent growth has not slowed down, but demand really has.
Well, that's right there in the title of the article, Class A. And you say that it's Class A tier that's managed to maintain a more typical level of demand this year compared to the others. Is that true throughout each market in the country?
There's some variance at the market level for sure. Nationally as a class, and again for ALN, Class A properties are the top 12% of properties in their individual market for average effective rent per square foot, is how we treat that. So when you group all of those Class A's nationally, that sector has been the most resilient from a demand perspective. But again, at the market level, there is some pretty substantial variance. Markets like Baltimore, Boston, New York, San Bernardino, Riverside, even which has been a pretty strong market in California lately. These are areas where there's actually a net decline in the number of leased units so far this year. So Class A has actually had negative net absorption in those markets. And then if you look at areas where they're underperforming fairly dramatically from last year for Class A properties, you're looking at markets like Dallas, Atlanta, Houston, San Antonio. Markets that you wouldn't normally think of really as struggling from an absorption perspective. And then I would say, interestingly too, the decline in absorption for these Class A properties really has been pretty consistent across sort of the primary, secondary, tertiary market divide. So it's not so much that it's a phenomenon just in the large markets. We have seen it be fairly widespread in that regard.
What do you view as either challenges for the non-Class A properties or the advantages for the Class A properties that created this difference in performance from absorption perspective?
For Class A, I think there's a few factors, right? So one would be that residents for Class A properties tend to have higher incomes, as well as a higher rate of jobs that have that sort of flexibility built in, whether you're talking about remote work or hybrid work. And so a lot of the net migration numbers we've looked at consist of workers who are able to work in one place and live in another place, and those are going to be more of your Class A residents than in some other sectors or some other segment of migration in the numbers itself. Anecdotally, I think that the ability to afford higher rents and work remotely has fueled some of the migration that we have seen. I'm now in Florida, and particularly you hear about people that are still working in New York, but now they're living down here in Florida. And so even after a 30% annual rent increase, that they're looking at the rents here as pretty reasonable compared to what they're used to. So you're seeing a lot of that, particularly in the Class A space. But also, there's historically low single family inventory, so potential home buyers are kind of on the sidelines, and that is sort of a boon for Class A properties. Historically high home value appreciation. Another thing that's making it difficult for people to convert to single family buyers. And then, of course, the rising interest rates and on mortgage loans would be another factor there. So, all of those things kind of combine to kind of boost Class A demand, whereas for Classes B, C, and D, you're talking about downside pressures that are at this point fairly widely discussed, right? So the rent growth that we've seen over the last year is a big component of that, just in terms of affordability for residents. Then you pair that with inflation in other parts of the economy, whether it's gas, groceries, whatever it may be. Um, and then also we have to keep in mind that in 2020 and 2021 there were still stimulus payments going out, and other sort of pandemic related responses that were affecting residents' cash flow that really are not the case now for the most part. So all of that is kind of how you end up with a demand crunch this year.
Well, it's June, and that means that it's NAA's Apartmentalized, and we'll be exhibiting in booth 1823 in San Diego. And we're talking about the upcoming launch of our all-new version of ALN Online. It's built specifically for owner management, acquisitions, dispositions, brokers, lenders, appraisers. That's at booth 1823. If you want to be among the first to see what we've been working on, make sure you stop by there. Jordan, how about you? What do you have coming up?
Well, unfortunately, this year I'll be off the NAA rotation, so I will not be there with everybody. But July 20th is, as it stands now, at least my next speaking event. So I'll be doing sort of a joint webinar with a company called Roof, who's a great company, and we'll basically be going over a little bit of what we talked about here today, just some of the reasons for the change in multifamily demand so far this year, and kind of what that means for the industry moving forward through the rest of this year and into next year. So be on the lookout for registration links and information on our social media for that. And then other than that, really, it's just we're going to have some good content going up on the blog, and I'm going to enjoy a little bit of a respite in the air travel.
You're right. To keep an eye out on our social media, that's you can follow us on Twitter at ALN APT Data, or search for ALN Apartment Data on Facebook or LinkedIn. Don't forget that you can like this video and subscribe to our YouTube channel. It helps us out an awful lot if you give us that like. And other than that, Jordan, I guess we'll see you next month, and we'll talk to you then.
See you then. Thanks, Patrick.